Hello, everybody. Thanks for tuning in right before the September deadline. My name is William Shiraga, and welcome to another edition of the Hodgin Law PC International Tax Lunch. We do this every month on the second Friday of the month, noon Pacific time. Listen in online through CalCPA or watch the show later on YouTube. This month's topic is dual status returns, what they are, how they work, and how to prepare them. In summary, when someone becomes a U.S. person or ceases to be a U.S. person for tax purposes mid-year, they may be eligible to file a dual status return. This session will address the major issues as well as the preparation of dual status returns. If you have any questions during the presentation, feel free to ask it in the box. I'll be answering questions live during the presentation. So here's a brief overview of what we'll be covering. First, I'll go over what dual status returns are, then how residency tests are used, as well as some exceptions to these tests, what to file when you find out you have a dual status tax year, special rules related to income, exemptions, deductions, and credits, how the foreign earned income exclusion works in dual status returns, and lastly, a quick example of what a dual status return may look like. On a side note, you should have received a sample return separately, which we'll go over towards the end of the presentation. So overall, dual status returns are like what they sound. They are returns for taxpayers who are both a U.S. resident and non-resident in 1 year. It does not refer to a taxpayer's citizenship status, but rather resident status for U.S. tax purposes. And this also arises from the fact that partial year returns are not allowed for individuals. So an individual can't just file one return that covers only the period they were a U.S. resident or non-resident, like filing a return from only January 1st to June 16th as a U.S. resident. Individual returns have to encompass a full year. In most cases, a dual status tax return is necessary during a transition year, either when a taxpayer enters the U.S. or when the taxpayer leaves the U.S. In this diagram, we have a foreign person who enters the U.S. sometime in 2002, lives and works here for a number of years, until leaving sometime in 2016. 2002 and 2016 would be considered this person's transition years. In other words, transition years are when the residency status of a taxpayer changes during the year. Depending on which way the residency status changes, two types of taxpayers arise: inbound aliens and outbound aliens. Inbound aliens are taxpayers who are non-resident aliens but become U.S. residents during the year when they enter the U.S. Outbound aliens are essentially the opposite. Taxpayers who were U.S. residents but become non-residents during the year when they leave the U.S. Residency tests play a big role in figuring out whether a taxpayer is a U.S. resident or not. It's usually the first step in determining whether a taxpayer is a resident alien, non-resident alien, or both in 1 year, as well as when their residency status changes during the year. So there are two residency tests to consider: the green card test and the substantial presence test. As these tests usually determine their filing status for the entire tax year, I'll first talk about how the tests work in a normal year. Then we'll look at special rules for transition years when you meet both the test and not meet the test, which might create a dual status return situation. starting off, the green card test is a pretty straightforward test. If you have a green card at any time during the year, then you are a US resident, unless the green card has been abandoned or taken away. Abandoning or surrendering a green card can be initiated by you personally, by the USCIS or the United States Citizenship and Immigration Services, or by a US consular officer. If you initiated it, then your resident status is considered abandoned when you file either Form I-407, which is the application for abandonment, or if you send a letter stating your intent to abandon your resident status with your alien registration receipt card attached. Taken away in this situation means when the US government issues you a final administrative or judicial order of exclusion or deportation, and you can no longer appeal this order. Note that just letting your green card expire does not mean that you are no longer a US permanent resident or US tax resident. You will still be considered having a green card unless you take the actions necessary to end it. This means that if you let it expire, but don't officially terminate the status, you continue to have an obligation to file US tax returns reporting worldwide income, not to mention information return reporting requirements as well. So the next test, the substantial presence test, on the other hand, is a math equation. Two conditions must be met to be considered a US resident during a tax year. First, you have to be in the US 31 days in the current year. And second, you have to be in the US 183 days in a 3-year period, including the current year. To see if you have 183 days or not, each day in the current year is fully counted, so whatever it is times 1, while 1/3 of last year's days and 1/6 of the days from 2 years ago are added. Now here's an example. Assume you were in the US for 300 days in 2015, 27 days in 2016, and 81 days in 2017. The first condition has been met with 81 days in the current year. But let's see if the second condition has been met. 300 days divided by 6 is 50 days. 27 days divided by 3 is 9 days. And 81 days divided by 1 will be 81 days. Add them together, and the total is 140 days, which is less than the required 183 days. Thus, in this situation, the substantial presence test has not been met. You will not be considered a US tax resident in 2017. So before moving on, let's break down the terms that make up the substantial presence test. Let's start with days in the US. Sounds pretty simple, but there's actually quite a bit to think about, much like everything else in tax law. The United States is defined as all 50 states plus DC, the territorial waters around the US, as well as the seabed and subsoil of submarine areas that are adjacent to US territorial waters and over which the United States has exclusive rights under international law to explore and exploit natural resources. So most likely that last part wouldn't have applied to you, but it's still in the definition. Note, this does not include other US territories such as Guam and Puerto Rico, as well as US airspace. So if you're merely flying over the US, you're not in the US for substantial presence test purposes. But if you're on a boat or submarine a few miles off the coast of the US, assuming you're in territorial waters, then you are in the US. Now let's focus on the definition of days. You are treated as present in the US on any day you are physically in the country at any time during the day, except for these following scenarios. So don't count the days you're in the US if you live in Canada or Mexico but work in the US. So you commute every day from Canada or Mexico, drive into the US, then you don't count those days when you're working. And then next would be if you're in the US for less than 24 hours because you're in transit between two places. Like if you're on a flight between Canada and Mexico, but you have a layover in Houston for a few hours, less than 24 hours, then you don't count that day you're in Houston. Next, if you're a crew member of a foreign vessel and you stop in the US, and then if you're unable to leave the US because of a medical condition that developed while you were in the US, note that this does not include someone who had a medical condition, then comes into the US for treatment and can't leave the US. So those days would count. It's only if you were in the US and then the medical condition developed while in the US when you don't have to count those days. And lastly, if you're an exempt individual. Exempt individuals include the following types and their respective visas. So foreign government related A or G visas, but not the A3 or G5 visas. Teachers or trainees temporarily in the US and complying with requirements, so with those with J or Q visas. Students temporarily in the US and complying with requirements, usually international students at US universities and colleges with visas F, J, M, or Q. And lastly, professional athletes in the US for charitable sports events. On a side note, if you exclude days of presence in the US for purposes of the substantial presence test because you're an exempt individual, or were unable to leave the US because of a medical condition, you must include Form 8843 with their tax return. If you're looking at this and wondering, darn, I don't like my residency status for the year because of the green card or substantial tests, or maybe you're not wondering that, but either way, there are a few exceptions to these tests in determining residency. The first is the closer connection exemption, which can override substantial presence test. You can use this exception if you're in the US less than 183 days in a current year, your tax home is in a foreign country, and you have a closer connection to one or two foreign countries where you have a tax home. Closer connection compared to the US at least. However, this exception can't be used if you applied for permanent resident status during the year, or if you already have a green card. So it's only really applicable to the substantial presence test. Establishing closer connection mostly consists of filling the facts and circumstances test. The more you can claim these are located in another country, the stronger your case will be. So where your home is, your family, where all your belongings are, where your business is, where you work, driver's license, voter registration, where your church is, etc. Where is your life essentially? So if you have a strong case for a closer connection to a foreign country, you should prepare Form 8840 and attach that to your Form 1040-NR. The effect of having a closer connection to another country than to the US is that it will be as if you never met the substantial presence test for the year. You're no longer treated as a US resident, and you don't have to file a 1040 or any information returns such as the FBAR, 8938, 8621, 5471, etc. However, if you have any US source income, you may still have to file as a non-resident and prepare a 1040 NR. Another exception consists of tax treaties. If the treaty between your country, a foreign country, and the US has a tiebreaker rule for residency, you can elect to be taxed as a non-resident in the US. You can use this election if you meet either the green card test or the substantial presence test. However, there is an additional risk for green card holders. It may become harder to renew a green card after using a treaty election, or you may accidentally expatriate. I'll cover this in a few more slides. So it's not advisable to use this method unless you fully know the implications. The effect of using a treaty election is that you can be treated as a non-resident alien for income tax purposes for all or part of a year. So you can elect to be treated as a non-resident from January 1st to cover the whole year, or from a different date in the year to cover a partial year. The latter option would cause you to file a dual status return. Also, you'll still have to file information returns, however. There is also the risk of accidental expatriation for green card holders who had their green card in at least 8 years of the last 15 years and choose to do the treaty election. Upon making the election, the US government will see that an expatriation event as of the date of the treaty election. This may also lead to exit tax if certain conditions are met. So one way to prevent this is if you had the green card for less than 8 years, then you can use treaty elections to keep the number of years you've had the green card not count towards the 8 of the 15 years. So let's say you've never done a treaty election before and had the green card 6 years out of the last 15. This year, you decide to do a treaty election to be taxed as a non-resident. You may physically have the green card for 7 years before the 8 of 15 year rule. This year won't count and you'll still be at 6 of 15 years and not subject to exit tax. Other possible elections include the Section 7701B4 first year election and Section 6013 spousal elections. The first year election is for non-resident aliens who move to the US after the middle of the year and do not hold a green card. So they won't qualify as a US resident under either the substantial presence test or the green card test. But this election will allow them to be treated as a US resident from when they moved into the US to the end of the year. There are a number of other requirements for this election, and this would lead to a dual status tax year, but someone might want to be considered a US resident for part of the year to take advantage of certain itemized deductions, such as mortgage interest or property tax, or they want to take foreign losses. And then there are the Section 6013 spousal elections to treat both spouses as US residents for the year, which allows for married filing jointly returns, assuming one spouse is already a US resident. Section 6013G election is used when the other spouse is a non-resident alien throughout the year. When this election is made, it will apply to the first year when it's made and to all subsequent years until it's terminated or suspended. For the Section 6013H election, the other spouse becomes a US resident by the end of the year. This election is only a 1-year election, as from that point onwards, it's assumed that both spouses are US residents and would naturally be able to file a married filing jointly return. So once you figure out if you are a US resident or not based on the residency tests, We'll need to determine if you have a dual status tax year and set the starting and ending dates for US residency. For the rest of the presentation, I'll focus on the two main residency tests and not on the exceptions. As a reminder, if we go through the residency rules and you're both a resident alien and non-resident alien in the same year, then you might need to file a dual status return. But at what point do you become a US resident or non-resident? Let's look at a couple examples of dual status tax year scenarios to help illustrate the dividing point between resident and non-resident in a given year. In the first example, Jill, a foreign national, enters the US for the first time in her life on February 1st, 2017. She then remains in the US for the rest of the year. From January 1st to January 31st, she's a non-resident because she's out in the world, just not in the US. But from February 1st to December 31st, she's a US resident because of the substantial presence test. If you're in the US for more than half the year, then you'll meet both conditions for substantial presence. Jill, in this case, would file a dual status return. Here, Steve's a green card holder, and he's been living outside the US for the past 2 years. He decides to surrender his green card on May 5th, 2017. Through the green card test, he's a US resident from January 1st to May 4th. Once he abandons it, however, he's no longer a US resident from May 5th to December 31st because he has no green card, and he's outside the US, so no substantial presence. Steve will also file a dual status return in 2017. Now, there are rules to help determine the start and end dates for residency. In the two examples, the first example follows the first year rule as it's Jill's first year as a US resident. And the second example follows the last year rule as it's Steve's last year as a US resident. The first year rule for determining the start date of US residency is pretty straightforward. It's the first day you're in the US if you meet the substantial presence test, the first day you're in the US as a green card holder if you meet the green card test, and it's the earlier of the two if you meet both tests. On a side note, if you are a US resident during any part of the preceding calendar year, and you are a US resident for any part of the current year, you will be considered a US resident at the beginning of the current year. This applies whether you are a resident under the substantial presence test or green card test. The last year rule for determining the end date of US residency is pretty similar to the first year rule. It's essentially the last day you're in the US if you meet the substantial presence test, the first day you no longer have a green card if you meet the green card test, and it's the later of the two if you meet both tests. There is a small caveat for the last year rule, though. By default, December 31st is the end date for US residency for tax return purposes, even if you leave the US in, let's say, January. You can establish a residency termination date earlier than December 31st, but you'll need to prepare a statement proving that your tax home is in a foreign country and you have a closer connection to that foreign country. In other words, the facts and circumstances test, where your life is located. More information about this statement and what needs to be on the statement can be found in IRS Publication 519, a pretty helpful document related to aliens, but also dual status returns and dual status tax years. Another side note, I just want to briefly mention that there is the potential to exclude up to 10 days of presence in the US in determining the residency start date or residency termination date if you qualify. A statement is also involved in order to take advantage of this, and more information can be found in IRS Publication 519. Now let's go over what to actually file once we know we have a dual status tax year. To start, married filing jointly or head of household filing statuses are not allowed for dual status returns. Married individuals have to file married filing separately. If you want to file married filing jointly and not married filing separately, there are the elections that I mentioned before and the exceptions to the residency tests. If you want to go that route, of course. Generally, head of household individuals will have to file as single. So there are two parts to the dual status return. The first is the dual status return itself. It's either a 1040 or a 1040NR based on your residency status as of the last day of the tax year. So 1040 if you're a resident at the end of the year, or a 1040NR if you're a non-resident at the end of the year. The second part is the dual status statement. This is to show the IRS income, deductions, exemptions, and credits for the first portion of the year where you had a different residency status than the later part of the year. This can be in a tax return format or however format you find most organized. I'll go over dual status statements a bit more in detail in a few more slides. There are two types of dual status returns for the two types of taxpayers: the inbound and outbound returns. If you're a US resident on the last day, then you'll file an inbound return, with the return being a Form 1040 with the words dual status return written on the top of the return, and the dual status statement, which can be a 1040NR, but with the words dual status statement written on the top. Since what the IRS will be taxing you on is the 1040 dual status return, the due date will be whenever a 1040 is normally due. So typically 4/15 deadline, with the normal extensions to 10/15. Note that for dual status returns, e-filing is not allowed. So you have to paper file it in order for them to accept it. If you're a non-resident on the last day, then it's essentially the opposite of the inbound return. You'll file an inbound return when the return being a Form 1040NR with the words dual status return written on the top of the return, and the dual status statement, which can be a Form 1040, but with the words dual status statement written on the top. You'll be filing a 1040NR, so the due date will be whenever a 1040NR is normally due, with the applicable extensions. So typically 6/15 and the extension to 10/15. As I said earlier, e-filing is not allowed, and you will have to paper file this return along with the statement. So let's go over the dual status statement a bit more in detail. As I mentioned before, the dual status statement doesn't have to be in tax return format, but it can be. Using a tax return format is typically the easiest method because everything is already laid out neatly, and for tax practitioners in particular, it's easier to carry over data from the statement to the dual status return. For what it's worth, the IRS also suggests the tax return format, so you can't go wrong with that method. That doesn't mean it's foolproof, but it helps to have it that way. In other practice, we use the tax return format to report income and deductions from the dual status statement, but we also include a Excel spreadsheet to reconcile income and deductions from the first part of the year with the second part of the year. On a side note, the taxpayer does not have to sign the dual status statement, only the dual status return. So what you sign on the dual status return 1040 and 1040 NR, that signature line would apply to both the return and the statement. To help explain how income is reported on the dual status return and dual status statement, here's an outbound example. Let's say your last day of US residency is June 30th, 2017. So for the first half of the year, you're a US resident, and the second half, you're not. You had 50K of US source income that was earned evenly throughout the year. On the dual status return, you would report the total US source income for the year, so the full 50K, while on the dual status statement, you would report income from just the first half of the year, so 25K. And here's a sample of the spreadsheet that we prepared in addition to the dual status statement and tax return form. Steve again, good old Steve, a green card holder, abandoned his green card on April 16, which causes the dual status division. From the left, you'll see line numbers and descriptions for tax items that had values on the dual status return, in this case the form 1040NR. Each line item has a breakdown of what made up that line. So for this sample, we have Merrill Lynch and Bank of America that make up the taxable interest. If we had multiple employers, then we would break it down with each employer for the wages line and other items as well. Income earned during the pre-expatriation period, when Steve had his green card, is reported in the next column. Numbers in this column would also match what's on the dual status statement, tax form 1040. If there were any non-deductible losses or some other non-deductible event, then we put something down in the column after that. Next, any effectively connected income earned in the second portion of the year after Steve abandoned his green card is reported in the column with that particular time period. Then, the pre-expatriation amounts and the post-expatriation effectively connected income amounts are summed together to get the numbers shown on the dual status return 1040NR, in addition to the non-effectively connected income, which would show up on 1040NR Schedule NEC. By breaking everything down between the two residency periods, as well as each line item, it's easier for the IRS to follow the return and the statement, and hopefully less likely for them to misinterpret something. Our goal, since it's such a complicated return with many parts, is to make it as simple as possible for the IRS to follow. Now that we have a general idea of what dual status returns and dual status statements are, let's delve into what you actually put in the dual status returns when it comes to reporting income, exemptions, deductions, and credits. Starting with income, for the resident portion of the year, you report worldwide income. For the non-resident portion of the year, you will only report US source income, and although relatively rare for individuals, any foreign source income that is effectively connected with the US trade or business. These are the standard ways income is usually reported for residents and non-residents. Just that on a dual status return, you'll be combining both aspects as we report both residency periods. Just to break down US source income for non-residents a bit more, US source income consists of effectively connected income that's taxed at graduated rates, the normal tax rates, and reported on the front page of Form 1040. And non-effectively connected FDAP income that's taxed at a flat 30% unless the treaty applies, and they're usually reported on Schedule NEC on the Form 1040 NR. Deductions are allowed to reduce effectively connected income, but not for non-effectively connected income. Effectively connected income is defined as income from sources connected with the conduct of a trade or business in the US. So usually active income, business income, not so much interest, dividends, or royalties. Uh, Exemptions aren't so helpful anymore since they're gone from 2018 until the foreseeable future. They're supposed to come back after 2025, but we'll have to see about that, given the current political climate as well as how hard it is for tax laws to be passed or changed. For 2017 and prior year returns at least, residents can claim personal and dependent exemptions, while non-residents are only allowed one personal exemption with some exceptions. The total deduction for exemptions cannot be more than your taxable income for the period you are a resident alien. So, deductions are another big one. No standard deduction is allowed on a dual status return. With the recent tax law changes increasing the standard deduction quite a bit to $12K for individuals and $24K for married filing jointly, along with the corresponding removal of personal exemptions, this can greatly increase the tax cost for dual status returns from 2018 onwards. The types of itemized deductions that can be taken depends on whether the deductions occurred during the resident portion or the non-resident portion of the year. For the resident portion of the year, it's whatever can be deducted on a standard 1040 Schedule A. For the non-resident portion of the year, it's mostly limited to deductions related to effectively connected income. With the changes made to standard deductions, itemized deductions, and the elimination of exemptions, a dual status return may prove to be costlier than prior years, so keep that in mind. For credits, most are available and are depending on whether you are a resident or non-resident. There are a few that can't be claimed, such as education credits, earned income credit, and a credit for the elderly or the disabled unless you're married and elect to file married filing jointly. So for resident aliens, most of the normal credits on 1040 NR are available. For non-resident aliens, foreign tax credits for foreign source income that is effectively connected income, as well as some other credits are available. Moving on to foreign earned income exclusions. In general, they're available to US citizens and resident aliens as a way to reduce or eliminate double taxation for those working and living outside the US. During a dual status year, you can use the foreign earned income exclusion for reducing earned income from the resident part of the year. The exclusion amount is adjusted annually for inflation, as well as subject to the same limitation exceptions as in a normal resident tax year. So for 2017, it's 102. You can exclude up to 102,100, and for 2018, you can exclude up to 104,100 of earned income, foreign earned income, usually wages, salaries, stuff like that. So to get the foreign earned income exclusion, you'll have to fulfill either the physical presence test or the bona fide residence test. On a side note, the physical presence test for the exclusion is different from the test for US residency. This physical presence test requires 330 full days or more during a 12-month period, not necessarily a calendar year period, and the exclusion is prorated for the period that occurs during the tax year. So you can count 330 days from 2016 to 2017. Not necessarily has to be all in 2017. The bona fide residence test is limited to only US citizens. But if you can show that you intend to remain in a foreign country indefinitely, and you have the facts and circumstances to back up your intentions, then you are eligible to use this exclusion. So basically, where's your life? And if you can prove that, then you can use the foreign earned income exclusion under the bona fide residence test. To help explain how the prorating works for the physical presence test, here's an example. A US citizen lives and works abroad from June 1st, 2016 to May 15th, 2017. That's over a year abroad, so that they definitely meet the 330-day requirement. For 2017, we would count the number of days abroad, 135 days, divide that by 365, and multiply by the 2017 maximum exclusion amount of 102,100 to equal the prorated amount that can be excluded for 2017. So for 2017, this person can exclude up to $37,763 and for in foreign earned income on their tax return. The 2016 portion works the same way, except the maximum exclusion amount to multiply by is different. Now that we've gone over everything that makes up the dual status tax return, let's try to actually prepare one. At this point, it will be helpful to pull up the sample dual status tax return attachment that came with this presentation so that you can follow along and see where everything goes. So setting up the scenario for this dual status tax return example, Bob enters the US on May 1st, 2017 and stays in the US for the remainder of the year. So for the substantial presence test, stays in the US, 2015, he was in the US for 0 days. 2016, he was also in the US for 0 days. And for 2017, he was in the US for 245 days. To determine the transition year dates, he does meet the substantial presence test since he was in the US for 245 days in total in the last 3 years. And he was also in the US for at least 31 days in the current year, or in 2017 in this example. The green card test not met because we're assuming that he did not get a green card and he's in the US as some kind of visa holder or just a foreign person in the US. Rule: the residency start date is the first day you're present in the US in this situation, so when the substantial presence test is met for the year. So his residency start date would be on May 1st, 2017. He had income throughout the year, but for Bob, only US source income would count, which would be from January 1st to April 30th, 2017. So any income, US income, that he earned during that period. And then from May 1st to December 31st, 2017, we would count worldwide income. So both US and from foreign sources. In this scenario, he can claim personal dependent exemption since he's filing a 1040 dual status tax return. In terms of deductions, since he will be filing a dual status return, he can only itemize and no standard deductions are allowed. For credits, he has all the normal credits available for the resident portion. And for the non-resident portion, he's limited to the non-resident credits available to him. In terms of income, let's assume he made $100,000 through a salary. $30,000 was before moving to the US, and since sourcing rules is based on where you did the services, this $30,000 will be foreign source income. And then $70,000 after moving to the US will be considered US source income. $25,000 dividend income from foreign stocks, $10,000 before moving to the US will be foreign source income and not counted. And then $15,000 after moving to the US, which would be counted since it's for worldwide income. And then lastly, $15,000 in dividend income from US stocks, $5,000 before moving to the US, and $10,000 after. Both will be reported since US source income is reportable for both parts of the year. So another summary of that, for salary income, $70,000 of US source income would go on 1040, and that other $30,000 would not be reported anywhere since it was foreign source income. And then dividends, foreign source, $15,000 on 1040, so for the latter part of the year. And then the US source dividends, $5,000 on the 1040 NR dual status statement, and then $10,000 on the 1040 for the dual status return. Now let's go over the sample materials that you should have received along with this presentation, the dual status return example. So towards the top, you'll notice that dual status return is written to signify that the 1040 is the dual status return. Below that, you'll see that the dates say May 1st, 2017 to December 31st, 2017 to cover the part of the year when he became a US resident by the end of the tax year. Below that, the identifying information, a single, one exemption for himself. Then on the wages, you'll see that the total 70,000 US source income goes on line 7. Below that, on line 9, for dividends, assuming that the dividends are qualified for both the foreign source and US source, the line 9 equals 25,000. This is the sum of the foreign source dividends earned after he became a US resident, the 15,000, and the US source dividends that he earned after he became a US resident, the 10,000. Combine that together equals 25,000. Note that that 5,000 of US source dividends that he earned before he became a US resident is reported on the 1040 NR Schedule NEC, and then we'll see as we go down the return that we report the 30% tax that was associated with that instead of putting it on the ordinary or qualified dividend line 9, A and B. So combined, 70,000 and 25,000 is 95,000. Next page. You'll see in line 39B, since he's a dual status alien during the tax year, that box is checked, forcing him to itemize. We're assuming that he didn't have any itemized deductions, so 0. At least for the 2017 return and prior years, he has that exemption of 44,050. Then the applicable tax in graduated rates, and then in line 62 is where you report the 1040 NR Schedule NEC 30% tax that was applied to the 5,000 on the 1040 or the 5,000 from the U.S. source dividends earned before he became a U.S. resident. So that covers the dual status return part. Next page, Schedule A is blank, show that he didn't have any. And Schedule B, showing that he earned the foreign source from a foreign company, 15K, U.S. source, U.S. public company, 10K, resulting in a 25K. Assuming he's also a Singapore resident, so he has no tax treaty that would allow him to reduce his 30% dividend taxation for his 1040 NR. Then the next page, the dual status statement, the spreadsheet that we usually include, showing the breakdown of each line item, with line 7 showing that he earned salaries from a global consulting firm after he became a U.S. resident from May 1st to December 31st, 2017. We don't include that 30,000 before he moved to the U.S. because that was foreign source income. Then post-arrival, added those together, the 1040 line 7 would have the 70,000. Then for the ordinary and qualified dividends, with the breakdown between the foreign and U.S. income, you'll see here that before the arrival of Bob into the U.S., he had 5,000 of U.S. source income that was reported on the 1040 NR Schedule NEC, and then add that to the post-arrival $10,000 of U.S. source dividend income, and shows that the 10K is on the 1040. Sum everything up together and you see the totals in the bottom. So the dual status statement portion would be the 1040 NR, or we typically use the tax return form. So like the dual status return, we have the dates on for the first part of the year, which covers January 1st to April 30th, 2017. Identifying info, filing status, exemptions, about the same. Then no effectively connected income in the situation. So the first page is mostly blank. On to the next page. You'll see the exemptions allowed to Bob of 4,050, at least for 2017. Then on line 54, you'll see the 1.5K tax for income not effectively connected with the U.S. trade or business. So essentially the U.S. source dividend income of 5,000 that he earned before he became a U.S. resident. Next page, we have the Schedule NEC, which shows that 5,000 taxed under 30%, and under the line for dividends paid by U.S. corporations. Then lastly, on the last page of this dual status statement, we have Schedule OI. Although the Schedule OI is on the dual status statement, since it's part of the tax return form, we typically fill it out with all the information just for completeness. So all the questions are answered in this page. And that's about it with the dual status return sample. A pretty simple example, but gives a rough overview of what it consists of, as well as what parts are necessary. So that covers everything related to dual status returns on a really high level. We went over what dual status returns are, the residency test to determine dual status, and how to prepare the returns. On a side note, be aware of also information returns that may be necessary. Since dual status taxpayers are U.S. residents during some part of the year, information return requirements arise. So be sure to check out Publication 519 for more information about dual status tax years. And here's the obligatory disclaimer. This presentation is not legal or tax advice. You cannot use it to avoid penalties. Please hire someone to help you. And thank you so much for listening. Thank you all for participating. Please send us an email if you have any questions that weren't answered during the Q&A session. Next month's session will be on October 19th, presented by Phil Hodgen. The topic will be expatriation, the tax consequences of relinquishing U.S. citizenship or green card status, which is related to dual status returns because typically when you expatriate, you tend to file a dual status return. So if you're not already on the mailing list, please sign up to get the announcements email about upcoming international tax length topics. Go to hodgen.com/newsletters to do this. Thanks again, and see you again next month.